Today I'm going to review the strategy that I'm going to prevail to you with a ticker symbol TROW Price Group Inc. This is a finance investment manager, and we have here the weekly chart. As you can see, it has gone down one level. From the top right here, going downwards, it has consolidated at this area. To find the duration of the consolidation, we have to click on the time frame. On the left side, you can click on the tool, scroll down all the way to date and price range. In the price range, you click on the beginning towards the end, and as you can tell, this is 1,000 days. 1,000 days, so about 1 to almost 3 years, over 3 years, so approximately 3 years. So 3 years of consolidation. And when you zoom in down to the daily frame, you can see a pattern. It's just going up and down at the same level. And we can find the resistance and the support by finding the common denominator. And it seems like this right here touches 1, 2, 3, 4. And when you go down to the support level, it seems like right there. So we have this consolidation in this area, and sure, it quite went below the support line. It's bound to happen, but you can see and tell that the frequent touches is in this area. When the resistance is broken, it usually comes with a higher volume, usually 2, 3, 4 times higher, but typically 3 times higher. A lot of people like to play the breakout. It's easier to see the breakout and put a stop loss right at the resistance line. But for the aggressive player, they like to play early before the breakout, because it seems like sometimes during the breakout, in their mindset, they think it's too late. But it's not, because usually, sometimes, it bounces back, it pulls back to the support line and bounces off of it. And it takes patience to get that, a lot of patience. And if you have patience, then that is a good play for you. And for people who wants to play it now, I would recommend you to buy it right here, because we drew a support line right here, and it looks like a ascending triangle. Do you see that? You see this angle right here? It moves up. It looks like an ascending triangle. We have the top. Having enter right here is about 108.55. My stop loss would be around $100. Are you willing to risk $8? Most likely, yes. $8 is like a cup of coffee. And if you're willing to risk more, you can buy 2 times. 2 times 8 is 16. So $16 is about a restaurant at the brunch. If you want a dinner, then 3 times. 3 times 8 is 24. So $24 is the amount that you're willing to risk at most. And if you get it wrong, then you can skip the meal. But otherwise, this is a good strategy. Having a stop loss and managing your more money and thinking about your risk you're taking. If you're risking for a cup of coffee, brunch, or dinner, that's the way to think about it. It's all mental. And what you see right here, can you tell? Most people will love to play one of the following. It is the cup and handle, or the ascending triangle, or the head and shoulders. Most likely, people would like to play the head and shoulder, or the ascending triangle, or the cup of a saucer, because one of those three are very simple. You have to stick with one and stick with it and practice. Or you can practice all three. The most number one thing to do when you are identifying your pattern, you have to find the depth. The depth makes a lot of difference. To find the depth, you click on the same tool called the date and price range. You click on the top, drag it down, and as you can see, it's about 33, 34% depth, which is a pretty average. When a person's playing, they love to play around 10, 20, 30%, no more than 50. When you have that in mind, the percentage of depth, you know how much you're risking. You can risk right here to 87 from the point you bought it at 108, which is very deep. Or you can play at the arm. You can say, where is the head and shoulder? I can't see it. I can show you right now that the head and shoulder, it starts from right here. This might be the left shoulder. This is the neck. And this is the head. Back to the neck. And this is the shoulder, the right shoulder. And wherever it may land. Right there. Now the head and shoulder, the head must be the biggest. It can be by a fraction. It could be almost like a double bottom from the right shoulder or the left shoulder. But the main technical thing is it has to be bigger than both shoulders. The left shoulder and the right shoulder can be any size, but it has to be less than the head. Now the next important line is the neckline. The neckline is measured from the head. So from this point and this point, we have the neckline. And it happens to be the neckline is slanted downwards. Now you be saying, when should I buy it during the neckline? This right here, you could have bought it. And then you could have put your stop loss maybe right here, and then you got taken out. Very sad. You curve into right here and put your stop loss right here and get taken out again. Very sad. Very, very sad. You could have done it right here and then get taken out again down at the bottom right here, which is very sad. Then you say to yourself, when should I enter? When should I enter? You should enter when the volume is high, like so. This right here has broken out, but can you see the volume is in red? Must be a bad side, right? Maybe. Look at that. But look at this. Look at that. Look at that volume. Should have you bought right here? Maybe. Or should you bought right here? Maybe. It could have been anywhere and you could have been stopped out so many times. That's why it is better to put your stop loss at the bigger picture. And the big picture is the head and shoulder. You have to find the point where the head and shoulder is happening, like right here and right here. You focus on the right shoulder and you say to yourself, okay, $100 is the way to put your stop loss. But you say to yourself, I could have went right here and get stopped out quick. Yes, of course, because the right shoulder haven't been developed. But you might say to yourself, right, how is the little shoulder right here? There's a baby shoulder. Can this be the shoulder? I said, yes, maybe. This can be the shoulder. This can be. Let's check it out. You're absolutely correct. This can be the shoulder. This can be the shoulder. So once it mounts above the line, like right here, you enter, you get stopped out one time. Okay, you say to yourself, I tried one time. I'm just going to wait for the second try. All of a sudden, it developed a shoulder, a bigger shoulder. So this one whole shoulder right here. And you say to yourself, okay, I'm just going to wait until it breaks out right here. It breaks out. You put your stop loss at the shoulder. $100. You say to yourself, you bought it at 120. It goes down to 108. You say, oh my, oh my. I've lost a lot of money. But you still have a chance at $100. You still have a chance. Where you say, oh my goodness, but I'm still down. Okay, just be waiting. You guys have patience. I have done the same thing also. I would have bought right here. But you gotta say to yourself, I'm willing to wait for the bounce. And the bounce happened right here. So you say to yourself, I bought it right here at 113. It's much better than 120. And then you put your stop loss at 100. Then you say to yourself, oh my, I'm still back down. It's okay, because if you manage your money and you say to yourself, did I risk one share, which is $13, which is a price of a lunch, a brunch, which is okay because you manage your money. You say to yourself, I'm willing to lose $13. It's okay. So you put your stop loss right there. It's okay, it's only $13. But if you bought at $8 right here, you say to yourself, I feel more comfortable at $8. Then you should have waited. You should have bought at 13 because you said to yourself, you can't afford brunch, but actually you can afford to lose a cup of coffee. So that time you should have said to yourself, I'm willing to wait until it goes down more. Right? That is the strategy that you have taken in mind. First, manage your money. Say to yourself how much you're willing to lose. A cup of coffee, brunch, or dinner. Then you look at the stop loss at $100. You say to yourself, a cup of coffee costs about $10, so I'm going to wait until it goes back down to $10, 110. It goes back to 110. You say to yourself, okay, I'll buy it. You buy it, you put your stop loss right here. But the better strategy is this. You wait for the downtrend to be over with by doing the array. You click right here, and you click on the higher low, and you say to yourself, when this moves above this line, I will buy into it, and then put my stop loss right here at 108. For example, it bounces off, it goes above this at 113. It goes 113, you buy it, you put your stop loss at 108, which is a more comfortable than putting a stop loss at 100. Then you say to yourself, okay, how about this right here? Yes, you could have put it right there and say to yourself, I could have bought right here, put my stop loss right here at 116. It does its thing. It goes back to 116. You lost money. Tough love, right? That's why it's always to be a good idea to put your stop loss at the shoulder. The shoulder is much better. And you say to yourself, what is the best way to do this? The best way is this. You drag it down to about right here. You wait until it breaks out this point. Because you see this breakout right here, you could have went in right here and get stopped out right there. You could have went right here and get stopped out again. And you could have went right here and get stopped out again. But right here and right here, that's the resistance. That is the resistance. So you right there, you see, and you can make it even sure right there. Perfect. So right now, you say to yourself, it has broken 1 time, 2 times, 3 times, 4 times, 5 times. When is it gonna happen again? Look at that. Look at that. What is a possibility will happen again? Would it happen again? We don't know. So it's best for you to put the stop loss at $100. This bouncy breakout, the failed breakout, happened so many times in history, and it might happen again. But you know for sure that this line is respected 1, 2, 3, 4, 5, 6, 7, 8 times. This is respected almost 8 times. So you have to wait. Either wait for the bounce off this line right here when it stays above 103, or you can wait until it crosses the down slant. You have many choices, but the main choice is to put your stop loss at $100. And you have to consider the EMA line. Look at the EMA line. It is coiling at this area. If it coils for a long time, and this for 3 years, most likely will go up. This coil, it went back down. This coil went back down. This coil went back up. This coil went back up. Can you see the difference? This was below the 200 EMA line. It went back up. This was below the 200 EMA line. It went back up. Now this is definitely below the 200 EMA line. This is below 200 EMA line. It is quarreling. It's messing around with the EMA line. Or the EMA line. This messed with it only one time, 2 times, 3 times. Let's take a closer look. It touches the EMA line 1 time, 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times, and almost 9. And it bounce. So 9 times. We go back down here and we count how many times. 1 time, 2 times, 3 times, 4 times, 5 times, 6 times, 7 times. Wait. 1 time, 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times, 9, 10, 11, 12, 13, 14, 15. Oh yeah, this is messing around the calling for a long time. So what do you think about this? I have a feeling that this might be it. Its calling could go up and back or down, but we have to respect this line. If it goes below, we have to play the rounded number. Let's just play the rounded number of 100. We have to respect $100. $100 a round number, and people love $100, right? So let's look for $100. Let's look for it. Let's just look for this $100. And $100 is right there. And you put on the weekly. Yes, it might be $100. We'll make it $100. If this thing goes below $100, I will not even touch it. If it bounces above, it bounces back up to $100, then I would consider it. Now the only thing we have to look at is this line. This line right here will tell you when to enter. This line right here will tell you when to enter. If it crosses this line, just enter it. Put your stop loss at $100. Put your stop loss at $100. That's what I would do. I would just buy 1 share and see what happens. And to look at the financials, let's see the financials of this company. Look at that revenue. It's somewhat stable, just the same. There's no growth. Let's look at the cash flow. $2.2 billion. Trailing 12 months is 2.2 billion, which is solid. They have money, they have cash flow. That means this company is surviving, of course. It's a very big company. The market is 24 billion. It has dividend 4.5%. I would recommend this for the for the dividend. And what I would do is just that. I will buy it around maybe 108, 106. Put my stop loss at 100. If you want to be more safe, then put it at 88, 86. 86 as stop loss. Just buy one share, see what happens. All I can tell you it's going to be a slow moving stock. If you want the fast moving stock, then I will go for the smaller caps. Otherwise, this right here will be very slow and you would have to wait for the breakout for a faster pace. And for sure, if it goes below $86, just stay out of it. Stay out of it. If it goes below $100, you can probably think about it if you really have to hold it. But if it goes below 86, just stay out of it completely. But I have a feeling since it's a head and shoulder, the inverse head and shoulder, then the probability of it going up is about 70%, 80%. So that's that. Thank you for watching and hearing. I hope you learned a lot of things. Hopefully you got some value off of this. And thank you so much. Good luck to you and let the fortune be with you.